the deep dive, our first one here in 2024. And my name is Drew Creekmer. I'm the Director of Advisory Services here at Creekmer Wealth. And I'm joined today by John Creekmer, our founder and Senior Wealth Advisor. And John, we got a whole bunch of ground to cover here to kind of set the stage for the new year that's ahead of us. But before we do that, how you doing? How was your Christmas and New Year's?
I'll tell you what, I'm doing great and had a good time, good into the year, good kickoff for this year. And so things going good. I was actually reading some articles about how recently we've seen an increase in ad spending across a lot of different channels. And I think a lot of companies with the uncertainty in the overall economy and with the interest rates moving up the way they did, inflation, a lot of companies decreased ad spending across the board. So we get a lot of ads, but I think they need to work on their algorithm on Facebook. I've been getting ads for like hearing aids, for like a rollator and a cane, for hip replacement surgery. So I don't know how old they think I am, but they should probably work on their algorithm a little bit.
Oh man, gotta love technology, right?
Oh yeah,
Yeah,
oh yeah. They
that's
can
amazing.
dial it in. I'm sure they'll do great. So
Yeah. Well, hey, let's talk. Let's hop into it. 2023 was a nice bounce back year. But as we're moving into 2024, we started getting questions from folks about, hey, what are the big things you guys are watching this year? What are the things in the economy, or even with it being an election year? What are the top two or three items that you're keeping an eye on? And so
yeah.
we're going to pop a chart up on the screen here and review it. First and foremost, this is a chart showing the divergence between U.S. equities versus global equities. And John, in the last 10 years, we've seen a massive bull market here in the United States. And what that's actually led to, and this chart is showing that, is that US equities have really become historically very overvalued relative to global equities. And when we look back over this chart, we see a number of other historic economic time periods, and that overweighting to US equities is at an all-time high. And so, John, when you see this, what kind of stands out to you about this?
I'll tell you, everything comes back to the mean. And so there's been periods of time, we know the US economy for the last 100 years has been a driver of innovation globally for that period of time. And with that, though, once you have a driver of innovation, then that also then corresponds into higher levels of profitability, higher thoughts on future profitability, and it does then set up for strong bull markets as far as within the U.S. equities, but also sets out for outperformance relative to international markets. However, there's been different periods of time. You look at this like the mid 1960s. You look at it again at the end of 2000, and then here recently in the last 10 years, you've seen a huge outperformance of the U.S. stock market versus the international markets. Whenever you see that, ultimately it always returns back to the mean for a period of time. And so now, if we boil things down even to a deeper level, in 2023, Drew, there was seven technology names that
Yeah.
really drove the U.S. market higher. And of those seven technology names, I think as far as market cap and representation, they actually represent close to 30% of the S&P 500. And so those seven names are the big boys, right? NVIDIA, Microsoft, Google, Facebook, and so it's a lot of the big technology names. So when you look at this chart here, you can say the U.S. market has outperformed, but a lot of that outperformance is tied to a handful of names. Now we do know coming back into things that things are going to turn back to the mean, which means we should see a little bit of outperformance in international markets relative to the U.S. markets. Now that being said, that does not mean that it's less risk. There's still risk involved, especially currency risk. But Drew, right now, as far as all the modeling that I do every day, we're starting to see momentum, especially with institutional buying starting to slow down. And it's been the last 4 weeks actually in those magnificent seven names. And we're starting to see things turn a little bit as far as momentum of buying is something we track. It's a deviation, really some variation of relative strength is what it is. But with that, the pricing as far as of those stocks is moving a little bit higher, but the momentum is slowing down. So we're already starting to see a turn and potentially some international exposure would benefit people nicely.
Yeah, absolutely. And so, John, how does that relate then to what we're doing on our clients' portfolios? We've talked about diversification being key in the past because it's almost impossible to time the market. But with that slowing momentum here in the major U.S. stocks that we've been tracking for a number of years, what are we going to do inside of clients' portfolios with that information?
You want to make sure, first of all, that your proper risk tolerance lined up with your portfolios. And so keep in mind, folks, we cannot control rate of return. What we can control is simply adjusting your risk that you have inside of the account. And so think about having a knob, and actually that knob you can turn left or right or up or down. And whenever you do that, you're simply adjusting the risk that you're putting into the portfolios. Right now, though, you have the ability to decrease risk by adding in some international exposure. And so currently, we're as far as, let's say, in our passive equity allocation, which that's our core portfolio that we have inside of a lot of our clients' portfolios. Currently, we're sitting right now, I believe it's about 10% on broad-based international and a little bit as far as in emerging markets. We're going to start nibbling actually a dollar cost average again to be increasing exposure. Now, we're not looking at going from 10% to 90%, but looking at taking some profit off of some of the high flyers from the last year and reallocating it back to the international space a little bit at a time just to gradually try to get some exposure there. But we're also seeing opportunities as far as in our growth portfolio with a number of the firms as far as on research that we track that have been very successful. They've actually identified some additional opportunities. One case in point that we've owned over the last year and a half is a company called Macro Libre from Brazil. And so we're looking at having some additional exposure there as far as in our portfolios, as far as an international technology company. We're also seeing infrastructure development. So I had actually spent some vacation down in Mexico. And while down there, I recognized that in Cancun, they've actually built very rapidly a brand new airport. And I was looking at the schematics, and the runways are actually about twice as long as they need to be for a traditional airline flying in as far as a tourist. And the runways are actually the length to bring in a lot of heavy manufacturing or heavy transportation coming, flying in both to the Cancun side and also the Pacific side. And then they've also built a high-speed rail cutting across the entire width of Mexico. And in doing that, as I was looking deeper as far as what they're doing, they're actually bringing in the distribution system to link up the entire eastern half of the United States with the western side of Canada and the rest of North America. And so we're seeing goods being shipped from China are coming into Mexico, then to be pushed through rail, which is much cheaper, cheaper than the Panama Canal, pushing it across then as far as for distribution in the eastern part of the U.S. So even infrastructure development, rail, we're seeing opportunities in different parts of the world that are undervalued right now. And so we have opportunities to invest in those things also.
Mm, awesome, awesome. So, guys, in your accounts, you'll probably see some changes here in the weeks ahead. Nothing drastic. I don't think we see something major needing to be changed, but we are going to start shifting into those areas that we see providing some great opportunities. Now, John, let's kind of shift to a different topic from stocks, and that's bonds. And for those of you that have been with us for a number of years, you know that we've been very bearish or negative thinking on bonds inside of portfolios going back to 2020. But what's interesting now as we enter 2024 is we believe there's some great opportunities to have a really great risk reward potential inside of bonds in your accounts. And what's interesting, John, going into 2022, bonds were actually significantly overvalued here in the United States. But what happened through the course of 2022 and the early part of 23 is interest rates were increased at the fastest pace in history, which led to bond values decreasing significantly. And so we are now at a position where bonds are actually drastically undervalued relative to what they will mature at. That's called par value. And we think there's a great opportunity to have some strong returns with the expectation that some point in 2024, interest rates are going to be cut, which we did see Chairman Powell talk about that at the end of December. And so we definitely think there's some opportunities there. So, John, what are we watching? We have a chart up here on the screen that I'll let you walk through, but what are we looking for on the bond side of our clients' portfolios?
Yeah, so the bond side, we're really looking to say what is the momentum or direction inside bonds or interest rates. And, folks, as a kind of a recapper, if you kind of think about a teeter-totter where maybe you're on one side and your friend is on the other side, whenever one side goes up, the other side goes down. And then conversely, the other side goes up, then your side will go down. And so when you think about interest rates, whenever one side goes up, that would be interest rates. So interest rates go up. The value of a bond that you may hold will go down in value. Whenever interest rates happen to go down, the value of the bond will go up. We know that in 2020 into 22 and 23, we saw the Federal Reserve increase interest rates at the fastest pace that they had ever done in the history of this, as far as with the Federal Reserve. And in doing so, that caused a negative rate of return overall as far as in value of bonds. And so we saw really the short term, intermediate term, long term bonds all went down. The Lehman Brothers Aggregate Bond Index in the year before, 2022, was actually down a little over 16%, one of the sharpest decreases in history as far as the bond index. Conversely, whenever interest rates happen to go down, well, then we know that interest rates have a huge impact on value of bonds. So if you own a bond that's paying, let's say, 6%, and interest rates go down to 4%, the value of your bond just became more valuable. Now, if we look at if you own a longer term maturity, so you can buy a bond from a bond is from basically 10 years to 30 years. You can buy a note, which is going to be 2 years all the way up to 10 years, or a bill, which is going to be less than a year, 12 months or less. And so the longer maturity you go in, it has a magnified impact as far as the rate of return that you receive whenever interest rates happen to go down. And so we saw rates go down. Now, quite honestly, they got a little bit ahead of themselves. And whenever we kind of look at what they've done, we know that it looks like at the end of November, we were end of October, the 10-year Treasury hit right at 5%. And then over the matter of a month and a half, it dropped down to 3.78%. Well, so that was a huge knee-jerk reaction. The market got ahead of itself as far as in assuming the interest rates were going to be decreased at a faster pace than what they probably are going to be. And so that set up for a little bit of a really quick rush as far as on interest rate readjustment. And so we've had a little bit of bounce back up. We're sitting a little over 4% on the day we're recording this as far as the last week. And so looking at that, we're saying, hey, they might move up a little bit here in the next couple of weeks, but after that, we're going to see a stabilization and potential interest rate movement down. Therefore, we're looking at finding ways to actually increase some exposure. We think we can lock in some extremely good interest rates in that 4 to 5.25% rate of return, as far as with a dividend yield. And then on top of that, having some price potential increases. So keep in mind, if you have a 10-year average maturity and we see a 1% decrease, that will give you a 10% increase in the principal of your bond, plus the 5% yield you're going to yield on that. You'll have a potential 15% rate of return on a bond investment next year. We see that as being a very low risk opportunity to increase your overall rate of return.
Yeah. And so how that translates then inside of client accounts, what our advisors are doing as they're meeting with each of you and doing reviews, we are beginning to thread in additional exposure to our bond portfolio for those exact reasons that John just laid out. And so that'll be a continual process as we move in here into 2024. Now, John, the last topic I wanted to cover with you, we were talking on the phone a couple of days ago, and I thought it was a fascinating conversation about commodities and some of the research you're doing in that area. We all know inflation drastically increased coming out of the 2020 stimulus that occurred. But you've been seeing some really interesting things on the commodity side, and that definitely translates then down in time to the price of goods that we are all seeing at the grocery store or the gas station. Can you kind of just walk us through some of those high-level things you're seeing in the commodities world?
Yeah, pull up on another chart, and if you have not been in my office, I kind of have a battle station with a whole bunch of screens around me. So it gives me the chance to actually go and look at different things. So as an example, Drew, one of the commodities that we're looking at as an example could be something like cocoa beans. And so it's interesting when I look at the price of cocoa beans, which cocoa beans are used to make chocolate. And so, as you guys know, I'm a lover of chocolate. Belgian chocolate is just phenomenal. But I will say my favorite chocolate in the world actually comes from Fort Wayne, Indiana. And so the company is called De Bronze. And the lady's name is actually Deb Rand. But great chocolate if you ever get no chance to be in Fort Wayne. And so the price of cocoa beans in November of 22 on a forward contract, you're looking at a contract trading at $2,356 per contract for delivery. Whenever we fast forward then and look at where it's sitting at today, actually 2 weeks ago, it hit 4,400 as far as in price. So the price of cocoa beans were up about over 90% in the last 12 months. Now, whenever I look at that, that's kind of interesting. And why is that? Well, we had demand push higher. We had prices push higher from all the currency being printed all around the world. but also there were some natural disasters that really took place, as far as with rain coming in certain parts of the world with deluge. And so it made where they couldn't harvest the beans. And so it pushed it higher. But whenever I zoom in and look at things, in the last week and a half, Drew, we've actually seen a decrease in the price of cocoa beans of 10%. Then whenever we look at the price of actual chocolate, chocolate nationwide in the United States is down 9.1% in that same period of time. And so it's going together, it's corresponding together. And we saw the exact same movement in actually my favorite morning breakfast, which is orange juice, which I do like a pulpy orange juice, in case you're ever wondering if we're having breakfast together. But I was noticing the price of my orange juice whenever I go out to a restaurant really increased. Well, frozen orange juice actually went up in the last year. It was up close to 100% as far as in the price of orange juice. They went from 1,600 on a contract. It got as high as 4,800 as far as the contract back in November. And so think about the price of the orange juice that you're buying based upon that commodity. It's actually went up drastically. But it is kind of a parabolic run in that some of that was just kind of kept on going higher and higher. But the thing that's fascinating is since the middle of November, the price of a contract of orange juice went from 4,200 down to 3,200 over the course of about 6 weeks. So that's a huge decrease as far as the price of frozen orange juice, which actually means within the next month or so, we should see a corresponding decrease in what we're paying for our orange juice in the store. And so, Drew, I think from an inflation standpoint, we are seeing some things that are happening. They're forward looking. They're actually causing prices to come down. The other thing we've not talked about is the Baltic Dry Index. And so, which is really the price paid for shipping containers to be shipped across the Atlantic. And the price on that actually has decreased about 70% over the last 3 months. And so all that being said, we're seeing some pressure that's pushing inflation lower. And I think that's be a relief for all of us.
Yeah, it definitely will. So, big picture, guys, there are always opportunities out there, and there's a number of opportunities that we've covered here today that we're actually very excited about as we move into 2024. So, we're proactively making changes inside of your portfolios, and your advisors will be talking about those changes with you as we continue to meet throughout the early part of this year. But if you have any questions about anything that we talked about today, don't hesitate to reach out to your advisor. Our team is fully briefed on all of these subjects and would be happy to walk you through how they relate exactly to your goals and making sure that you're properly invested for achieving those big goals that you have. So, guys, thanks for the time. Look forward to talking to you soon, and we'll see you all soon.